housing market collapse is coming. The U.S. economy has been contracting very fast as many businesses suspend their operations. The stock market is also very volatile because of the recent market crash. Experts are warning that this crisis will spread even to the housing market. The question that most people are asking is whether this housing market crash will be similar to the crash we had in the 2008 financial crisis. The opinion of most economists is that there is a possibility that this housing market crash will be bigger than the 2008 crisis. Why? Well, many indicators are pointing out that this housing market will collapse in the same extent like the stock market. Because of the current economic meltdown, the stock market has collapsed by about 30%. There are warnings that the market will fall further. If this is the case, it means that the housing market will crash by approximately 30 to 40%. There is a very high possibility this will happen because for years the housing prices have been rising. This has created a big bubble that's about to burst before us. It is very clear that the current collapse of the broader economy will affect the housing market in the near future. Despite the Federal Reserve's unlimited pumping of cash to the economy, big trouble is brewing in the mortgage market. It looks the way it was back in 2007 prior to the global financial crisis. The Wall Street Journal has reported that the AG Mortgage Investment Trust, which is a real estate investment trust operated by the New York hedge fund Gordon & Co., is among the institutions feeling the pressure because of the current turmoil in critical areas within the credit market. Now, because of this, they're examining a possible asset sale because they're predicting that this global panic will continue in the near future. Because of this global panic and turmoil in the markets, the company and its subsidiaries have registered a hike in the number of margin calls from their financing counterparts. This is not happening only in one company, because Bloomberg has reported that we have a $16 trillion issue in the U.S. mortgage market. It's now the epicenter of the next global financial crisis. The 2008 financial meltdown will be nothing when compared to the financial crisis that's about to explode in the housing market. The current turmoil in the global economy is already setting off an alarm in the financial sector. This is what is forcing the Federal Reserve to intervene in a manner that we've never seen before. They're pumping trillions of dollars to make sure that the market remains liquid. However, the central bank's intervention is very limited because the Fed is focusing on the agency home loans and only the commercial mortgages that were created with the involvement of the federal government. This means that the Federal Reserve's intervention will not help the markets in the long run. Regional brokers are under pressure to offload some of the mortgage bonds because of the increase in margin calls as a result of this global economic shock. Flagstar Bancorp is one of the biggest lenders to the mortgage providers in the United States. On Friday, they announced they will stop funding new loans to purchase homes if the loans are not backed by the government. Other lenders have also been tightening their terms of financing to various mortgage providers by either refusing to support some kinds of loans or raising the costs associated with financing. Some of the mortgage funders, like the Angel Oak Mortgage Solutions, said they're pausing any loan processing for the next 2 weeks. This is because everything is too volatile in the markets. This is making it difficult to evaluate credit risk in these loans. Now, over the weekend, the condition in the housing market escalated, especially when some of the funds rushed to raise more cash by requesting some offers for their bonds that are backed by home loans. Right now, there is a lot of risk in the mortgage market, and concerns about the mortgage market are growing every day. The mortgage bonds could be the source of turmoil in the market because this might increase the borrowing costs for consumers who want to buy homes. It is ironical that the mortgage rates have sharply increased in the past weeks, even if the benchmark rates are low because of the recent decision by the Federal Reserve to cut interest rates as a way of cushioning the economy. It is very clear that the Federal Reserve will do whatever it takes to make sure that the financial markets are functioning in a normal way. However, the root of this problem is that investors and the financial institutions are desperately looking for cash, and the Federal Reserve's decision to cut rates may not be the final solution when it comes to stabilizing the markets. All these unfolding in the financial markets are similar to what happened in the 2008 global financial crisis, when some of the funds were over-leveraged in the markets. Funds were overexposed to the mortgage-backed securities and various over-leveraged derivatives at the same time. This was the main contributor to the crash of the 2008 housing bubble. This had a domino effect to the economy. The current economic meltdown has ravaged the stock market, and at the moment the market is down more than 30%, and in the process wealth worth trillions of dollars has been wiped out in less than 2 months. The whole global economy is spinning. It is very clear that the U.S. housing market is also headed to a crash if the economy continues with the current trend. In the last 10 years, the U.S. housing market has enjoyed some decent gains, but within a short time, everything is changing. The U.S. housing bubble has already begun popping in various markets. It'll be a matter of time before this meltdown turns out to be a full-blown housing market crash. Late last year, we had very low mortgage rates. This is what made the house prices skyrocket. Millions of buyers took advantage of the favorable rates to purchase more homes. High demand, low inventory levels was the key contributor to the increase in prices until the end of 2018, when the increase in prices started slowing down. The average sale price of a home was flat in the fourth quarter of the year compared to the third quarter. This decline in home prices spilled over to this year, and the economic slowdown is threatening the stability of the housing market. The housing bubble has just begun bursting. Experts are warning that the worst is about to happen. Because of this economic fallout in the first quarter of 2020, the demand for homes is likely to hit a record low. Economists are already warning that the U.S. economy is slowly plunging into a recession, and if the current health situation is not addressed promptly, the current economic meltdown might end up being a depression. Actually, economists from Goldman Sachs, Morgan Stanley, and other investment firms are warning that this is just the beginning of economic fallout, and the worst might happen in the next 1 to 2 months. If this happens, the U.S. home market will be hit very hard, because consumers will be spending their money to buy only essentials during this crisis. Home buyers will obviously buckle down. The demand for houses might decline by up to 50%. Everyone has already been affected by the economic meltdown. The majority of people will not commit themselves to take new mortgage loans because the future is very uncertain. We can learn many lessons from the 2008 housing market burst, where the housing market declined by about 8.4%. Because of this, wealth worth nearly $2 trillion was lost as the housing market crashed. Reports show that 11.7 million homeowners in the United States were under the water. This meant that their homes were worth less than their mortgage balances. In contrast, by the end of 2019, more than 5.2 million homeowners were under the water, and at the same time, millions of people were still buying more homes. This is the exact replica of the 2008 housing crisis. The only difference is this time round, it will be more severe because the economy is already a blink away from a total collapse. This is bad news for the U.S. housing market because experts are warning that in the first quarter of the year, home sales will decline by up to 20%. Because of the recent economic crisis, thousands of businesses are shutting down. As a result, millions of Americans are expected to lose their jobs. Hotels and airlines have fully shut down their operations for the foreseeable future. Other businesses have already suspended their operations, and as a result, millions of people have lost their jobs. Among these people, many of them have mortgage loans. This means they will not be able to pay their dues on time. A cascade of mortgage loans defaults is expected. This might be what will blow up the housing market. This housing crisis will be several times bigger than what we saw back in 2008. The near future looks dark. This might be the only chance the government has to help the troubled housing market and the economy at large.